Hi, and welcome to everyone in Europe, Asia, the US, to the latest in a webinar series called Global Connections, which the Peterson Institute has been running with me moderating as we think about how to reconnect the world. What are the main issues that macro policymakers need to think about? And today we've got a terrific pair of speakers, Gita Gopinath, who is the chief economist and head of the research department at the International Monetary Fund, the IMF, and Peter Orszag, who is the CEO of Financial Advisory at Lazard, and of course, formerly in the Obama administration, running the budget there. And the topic we're going to deal with today is one that the IMF really pointed to last week in their spring meetings, which is divergent recoveries. And we all know that the pandemic and the pandemic recession hit actually the people that could deal with it least well the hardest. And it turns out that was true for countries as well. And looking forward, the IMF projects that some of the better off countries, including the United States, are going to grow more rapidly and recover more quickly from the pandemic recession than other countries. And this, of course, poses questions and challenges for the emerging markets and low-income countries who so far have been able to have had less fiscal space and are also vulnerable to changes or dependent on changes in growth and in policy in the richer world. So that's our topic for today. And I'm going to turn first to Gita and then to Peter for opening remarks. And then we'll have a discussion. If you have questions to ask, as I'm sure many of you do, please use the Q&A function, which we will be able to see and read your questions. So over to you, Gita.
Thank you, Caroline. It's great to join you and Peter in this conversation. Thanks so much for having us. So let me just first start out with, I think you might want to mute yourself, Caroline.
Yeah.
Yeah, thanks. So let me just start out with the basic picture that the points you made about multi-speed recoveries across the globe. So if you look at 2020 itself, and you look at the hit to advanced economies versus emerging and developing economies in 2020, measured as the gap from where they would have been in the absence of the pandemic, that actually doesn't look very different across the two income groups. So it's around 6% was a hit. But it is the recoveries that look very different. So if you look at where advanced economies will be in terms of our current projections in 2024, the gap relative to where they would have been in the absence of the pandemic is less than 1%. So it's a really small amount of scarring. But if you look at emerging and developing economies in 2024, that gap is around 5%. And so with very significant size. So it is really the differences in the speed of recovery that's the most big part of the story, not so much the original hit. And the other piece, of course, is that even within these income groups, there's very strong differences in recovery speeds. There's the US, which is recovering much faster than many other advanced economies are. And among emerging and developing economies, China is recovering much faster, much less scarring, US much less scarring compared to many other countries. So this is the divergent recoveries that we're seeing. Given the topic that we decided to talk about, which is the phenomenon of rising interest rates and the consequences that can have for other countries in the world, especially emerging and developing economies, I'm going to focus my remarks on this new analytical work we put out as a part of the World Economic Outlook, one of the chapters, which was exactly identifying financial spillovers, the consequences in terms of financial spillovers to emerging and developing economies that comes around as interest rates go up in the US. So we have seen since the start of the year, we've certainly seen US long-term rates rise quite rapidly. But again, overall, the rates are still low. Real rates are still very negative at the shorter horizons. What we did see was, while December and January, we saw this boost in capital flows into emerging developing economies. When we got in towards the second half of February, there was what looked like a strong pause, some reversal, but now we see things coming back, but again, in a weak form. So this, of course, leads us to the question of where will all of this head? Like, what is likely as interest rates go up in the US, what impact will that have on the rest of the world? So here in this particular research that we've done, I would say there are two big sets of takeaways. The first big set of takeaway is that it really matters why interest rates are going up. So the source of what's driving the increase in interest rates in the US is critical for implications for emerging and developing economies. The second big block is that country circumstances do matter, the kinds of institutions you have, the way your fiscal policy is run, the credibility of your central bank and the monetary policy. All of these pieces matter. So now let me just dive into these two blocks. The first block, which is that the details matter on what's driving interest rates. So again, if you look at past data and you look at periods when interest rates have gone up, but if they've gone up because of surprisingly good news in, say, US job market, so non-farm payroll surprises on the upside, that does cause interest rates to go up. There's the expectation of interest rates going up in the future, so it feeds into interest rates today. But such events, if anything, actually improves financial conditions in emerging markets. So it has positive spillovers. Emerging markets receive portfolio flows because risk appetite is improved with better growth prospects. This reduces borrowing spreads. And again, so this is on average the story. Of course, if you're a country that doesn't trade very much with the US or is not very much export oriented, you're not going to benefit from that. And if you're very heavily reliant on borrowing, then of course that's going to have, you're not going to benefit as much. The second is when we look at episodes where inflation again surprised on the upside in the US, we don't see, again, based on historical evidence, much systematic effect of this on emerging market interest rates, on exchange rates, or on capital flows. Now, the picture becomes a little darker when you look at rising interest rates that come around because of because of a monetary policy tightening that is a big surprise. So there's some sort of a surprise, more hawkish stance of US monetary policy, then those kinds of interest rate increases tend to have pretty negative spillovers to emerging and developing economies. Portfolio flows, capital flows reverse, big currency depreciations, term premia rise, borrowing costs rise for emerging developing economies. So again, so the details really matter. And of course, again, this is on average the picture that you would see. So the question is, what do we see now? How would I describe where we are right now? Is it the good kind of interest rate rise, or is it the difficult kind of interest rate, right? And right now, I would say that so far, there is more of good than bad. There is a bit of blend. There is, both the pieces are in play, but I think that the good news is still a very important part of the story. So the fact that, they're having higher growth in the US, which has spillovers obviously to the rest of the world, causing commodity prices to go up. All of that is feeding in, is helping with the situation. So let me just give you some examples. So if you look at how much the dollar has moved since the start of the year, it's appreciated around 2%. If you look at the movement relative to emerging developing economies, and if you take the MSCI emerging market currency index, that index has depreciated just about 1% relative to the dollar since the start of this year. So while there are exceptions, you've seen large depreciations in Turkey, in Brazil, and Argentina, but more generally, that's not the story. Now, there is, of course, the fact that there is a lot of uncertainty, again, about inflation. There's uncertainty about what's going to happen with asset purchases, US, central bank purchases. the amount of debt that's going to be put on the market coming forward, which is quite sizable. So all of that uncertainty is there. And that's, I think, part of the reason why it's showing up also in terms of higher term premia in emerging markets. So the borrowing costs are going up, so that you do have that effect over there. Okay, so now in terms of what should be done to make this period going forward, the future, a little more kind of better managed or better behaved. I'd say there are kind of three sets of things. One, of course, is what the source country does. And in this case, the US is the source country. So there is what exactly do we want the US to do? Then there is the second, which is what does the destination country do, which is what does the individual emerging market have to do given their particular circumstances. And then there's a third piece, is what does the international community do? What does the global safety net, financial safety net have to provide? So let me just go into those three. Again, from the source country part, this is no surprise. This will require very strong Fed communication. And I would say that it has been very strong recently. It has been very clear, very transparent, with sufficient advance warning about when things are going to change in their monetary policy stance, why they might be raising interest rates, why they might be tapering asset purchases, kind of very clear communication. That would be absolutely essential to ensure there's nothing like a very serious taper tantrum that destabilizes growth in emerging developing economies. Second is in terms of the destination country, a lot depends on the country that you are. So if you are an open economy, you're trading a lot with the US, you do benefit from the growth that's coming out of the US. If you're a commodity exporter, you've seen an improvement in conditions. Let me give you the example of South Africa, for instance. Last year, South Africa, the currency depreciated very heavily. It was in a difficult situation. But now as commodity prices have gone up, you know, the South African rand has barely moved relative to the dollar since the start of the year. And then the second is, of course, you want to be able to preserve monetary policy autonomy so that you can use your own domestic policy tools to guard against any kind of disruptive market conditions. Your ability to do that will depend a lot on your sound communication at home in terms of your own policies. We find that if you have strong inflation targeting regimes, flexible exchange rates, transparent central banks, then you have more wiggle room to do it. And we've seen it is these countries, for instance, who've been able to use asset purchase programs also to shield their domestic borrowing costs. Again, within countries, again, compared to 2013, while emerging markets are in a more difficult situation in terms of high levels of debt and higher levels of fiscal needs, and in a crisis still, you know, compared to 2013, they have much larger, the group as a whole has much larger foreign exchange reserves. They're running smaller current account deficits. So again, if, you know, countries that have the larger reserves are in a better position. And of course, it's very important that when central banks, you know, do what they do in emerging markets, that they kind of make it very clear the intention with which they're doing this in terms of preventing market disruptions while sticking to their mandate. And of course, I would say that all emerging markets should prepare. I mean, it's a good time in general to make sure that you are taking the relevant prudential steps to have financial stability, kind of hedging currency exposure, extending maturity, and so on. These would all be done. And let me end with the last point, which is on the global financial safety net. You know, there are many parts to it. One of the pieces that we did analyze in our research was, for instance, the impact of central bank swap lines. So when the US Fed last March provided these temporary swap lines and for the first time extended it to Brazil and Mexico, you can actually see that when that happened, you know, the performance of Brazil and Mexico relative to other emerging markets, whether you look at exchange rate movements or you look at borrowing spreads, they did better. So those have positive effects. The second piece, of course, is, you know, the IMF, the global safety that we provide alongside other funding institutions, the flexible credit lines, the precautionary lines for countries to have in place to guard it, you know, kind of to be in a good situation if things go bad. And also a new allocation of SDRs also is one of those instruments that can help build confidence, build up countries' reserves, and help with a situation of this kind. The third, of course, is that there are, of course, some countries, especially low-income countries, and also some emerging markets where debt is already very high. Debt relief will be an important part of the solution, but you might actually also need to do debt restructuring in some cases. And so again, the G20 debt restructuring framework, comprehensive framework with debt treatments, is another important part of this toolkit. So let me just start with that, Caroline.
Thanks very much, Gita. Certainly lots to think about there. And Peter, I'd love to hear your take on this question about divergent recoveries and how emerging markets will and should and can fare.
Sure, and thank you for having me. It's a pleasure to be with everyone. There's little in what Gita said that I can object to, but let me try to highlight a couple points that may be a slight source of divergence. And I'll start with kind of the base case and what's happening in the developed world, turn to some of the emerging markets and low-income countries, and then in the final bucket, talk about what can be done. So first, I think it's very important to remember that the policy response in the advanced economies has been remarkable, but not to get ahead of ourselves and to constantly be humble in terms of projecting forward. We've been wrong many times before, and I think the last year or so highlights that. So I would point to three main risks to the economic outlook, which is the base for this discussion, because we're sort of just assuming, clear skies ahead for the advanced economies. And I think the three risks are vaccination, zombification, and militarization. So let me just briefly talk about each of those. So first on vaccination, here in the US, we are clearly moving from an era of excess demand to one that will be characterized by excess supply quite quickly. But the question is, what share of Americans will wind up wanting to get vaccinated? In today's highly polarized environment, it's not clear that it will be as high as it should be. We're already seeing the pattern at the state level of dose administration rates being polarized along conventional political lines. I think it's entirely possible that we'll top out at 150, 160 million Americans vaccinated, which may not be enough, especially because there are questions about the mutation of the virus itself. I would highlight in particular the B1526 variant that is circulating in New York as being one that I think is of more concern than than the attention it's been receiving in the press. There's also a question about exactly how long the vaccine remains effective. We still do not know this yet. And I would say the concerns about the public health dimension, which is the first piece, are only stronger on the continent relative to the United States, where on the continent, vaccination rates are less than half of what they are in the US and the UK. And the controversy surrounding at least one of the vaccines has undermined public confidence. So it's not clear exactly how quickly Europeans will become too. And Gita mentioned scarring. I want to just be cautious here that returning to potential does not mean that there's no scarring. The scarring could occur at the micro level, sector by sector, even if the overall total looks fine. And this brings us to the second point, which is about zombification. I think it is noteworthy that there were literally no corporate defaults in the United States in January. Just pause and think about that in the middle of the kind of economic stress that the pandemic has caused. The volume of high yield bonds that are trading at or below $70 on the 70 cents on the dollar is now under $10 billion or under 1% of the non-defaulted universe. Just for context, about a year ago, that share was 17%. So we're in an era where it looks like liquidity has solved all problems. And I think the question becomes, is that a real thing, or is that just temporarily covering over underlying scarring that's happening at the sectoral levels? As we withdraw government support and as some of the available liquidity evolves, we'll know for sure, but I think it's premature to be assuming that we've skated past the problem rather than it's just building underneath the surface without an apparent top line effect. And then the final thing with regard to the advanced economies is it's striking to me that my foreign policy and national security friends are much more concerned about the risk of conflict between China and Taiwan as an example, but also Russia and Ukraine than pretty much any macroeconomic discussion features. These risks are not being incorporated into macroeconomic forecasts or, for the most part, financial markets. And I'd say the divergence between the foreign policy community and the economics community is quite pronounced. Obviously, that would substantially change the otherwise sunny picture that's being painted for the advanced economy, anything in that category. And I'm going to return to the US and China in a second with regard to the developed world. So just some caution about the smooth and strong recovery that is sort of predicated on the first part of this discussion. But for the rest of it, I'll just accept that as the operating hypothesis and turn to emerging markets. Few things. First, clearly on the pandemic itself, there's a dramatic difference between vaccination rates between the advanced economies and the rest of the world. Something like 85% of the shots to date have been administered in high and upper middle income countries who represent a vastly smaller share of the global population than that. I think there's also a question about the efficacy of some of the it's not just the vaccination rates, but also the specific vaccines that are being deployed in many countries. Chile is a great example, which is an outlier in terms of pretty high vaccination rates, pretty high overall vaccination rate, but reliance on the Sinovac vaccine, which I think there are now growing questions about its efficacy, especially after one jab, but perhaps even after two. This is obviously important because it will feed into the outlook for the developing economies, including a big question that I think we haven't really grappled with, which involves travel. So even in countries where the virus is well contained, China being a good example, the vaccination rate is very low, and that means that there's not going to be a lot of travel to or from without a significant impediment in terms of the amount of time that you need to be holed up in a hotel or isolated, which puts again, a lot of sand in the wheels of many of the interactions that lead to economic growth. Two caveats or good news on otherwise not so great outlook with regard to vaccination and the pandemic itself in the developed world. First, in the developing world. First is obviously the demographics. The advanced economies are just older and therefore more vulnerable to the virus than many emerging markets. The share of the population that's over age 65 is under 5% in a country like Nigeria. It's under 10% in Brazil, India, Indonesia. In most of the developed world, we're at 20% or more, and that is a very important difference in terms of the impact of the pandemic and the virus. And the second thing is, it does appear that there is now, over the past couple quarters at least, less sensitivity of economic activity to the pandemic itself. This may be because we've gotten somewhat better at targeted social isolation steps. It may be because more activity is easily transactable virtually. So that is a caveat, but I think overall the lack of vaccination and the implications with regard to interactions with the advanced economies are going to be a weight going forward on lots of the developing world. Second point that I'd like to highlight is I think we have underappreciated the conflict between the US and China and its implications for much of the emerging market world on a whole variety of things, including capital flows, debt, economic activity. As we know, China is the largest single bilateral creditor to emerging markets, despite not being part of the Paris Club. Conflict between the US and China that could manifest itself beyond just the 5G technology and the sort of technology Cold War into a growing number of areas is going to leave a lot of emerging markets and low-income countries caught in the middle, a phenomenon that I don't think that we have given sufficient attention to yet. And then the third thing that I wanted to highlight, which then blends into the what do we do about it, involves sovereign debt. Low-income countries in particular have not responded to the shock of the pandemic as aggressively as especially the advanced economies. So you saw, for example, an average fiscal deficit of 10% of GDP in the advanced economies, developing economies with a deficit of about 6%, and the low-income countries only under 2% of GDP in response to the shock of the pandemic. I think that highlights ongoing borrowing capacity problems and an inability to handle the shock that has occurred as a result of the virus. The result of that, despite pretty modest fiscal responses in the low-income countries, not only feeds into the differential that Gita started with regard to the recovery in the advanced economies relative to others, but it also does affect the debt to GDP ratios, which have been rising. It is noteworthy that there is not a particularly high correlation between the debt to GDP ratio and sovereign debt problems, but it is also the case that we have been delaying many of the sovereign debt problems that are likely to arise in the aftermath of the pandemic. So that then brings me to what do we do about it? I think the first and most important thing that Gita also noted is that we should be thankful that Fed Reserve Chair Powell is waiting to see actual inflation before acting preemptively to raise rates. That would acting preemptively would exacerbate, I think, the fundamental concern behind this gathering, which is whether higher rates in the advanced economies will cause capital outflows or problems in the developing world. Obviously, that the reason that rates go up, as Gita said, is important. The fact that the Fed is not feeding the rise in at least real rates, I think helps to attenuate many of the concerns that we're talking about here. And I'll just end by, because I see that I've gone on a little bit longer than I anticipated, I'll just end by saying that I think one of the absolutely essential things that we need to be focusing on is reform of sovereign debt contracts and the process of resolving sovereign debt challenges, because this had been the focus of a previous Peterson event, but we still have not made sufficient progress on everything from value recovery instrument becoming more systematized to reform of the so-called collective action clauses that could be modified, a whole series of other procedural improvements that would help us when we get to the point of having to resolve the sovereign debt problems that have been deferred, resolving them more successfully. And perhaps during the Q&A part of the discussion, we can also talk about the common framework and what needs to happen there. But back over to you.
Thanks so much. Again, a lot to think about and a lot of different topics. You're right on the sovereign debt. That was one of the issues that I worked on as a junior economist at the IMF back in, a few crises ago. So yeah, well, but I think we've come a long way since then, but it's always a tricky thing, as is the other issue that you raised about zombification and how to deal with that and so on. I want to step back a little bit to start off with and go to you, Peter. The response of the international community to this recession was very different from that of the 2008-9, which was really marked by a coming together of the leaders of the major economies, the first leaders summit of the G20, and a cooperative plan on macroeconomic policy, as well as a commitment not to resort to protectionism and so on. I wonder how you see, you mentioned this tension between the US and China, and I agree with you, it comes up a lot in some circles, not so much in market and economic circles. Do you think that what's going on is right now between the US and China is impacting American growth, American companies? Because I think that many companies still look to China as a place to grow and develop, but at the same time, we've got, because of the geopolitical tensions or the political national security tensions, increasing sanctions and problems like that. So I wonder how you see, you're in touch with what a lot of American companies are doing, and how do you see that impact? And of course, if you have a more general comment on what is different, that would be great. And then I'll turn to Gita.
Yeah, a couple comments on this. The first thing is, and I'll get to the general in a second, but first on China in particular. I think a lot of the pressures that are being placed on multinational companies are going to get significantly exacerbated over the next year or so. The Olympics will be a particular flashpoint where for many companies, there's simply no good answer because to respond to many of the ESG and other imperatives that executives understandably want to speak out on may be in conflict with being an active participant in the Olympics in a way that helps shore up their position in China in particular. We're obviously seeing this, the leading edge of it involving cotton production in Shenzhen. So there's, I think, more of that to come. And this is part of a broader theme of corporate executives entering spheres that had not previously really been corporate to say. It's the politicization almost of companies out of necessity, because staying silent is still an answer, speaking up is an answer, and so they're walking a very difficult path. That's point one. Point two is, I think we are going to see, and what's different here relative to the last economic downturn is increased nationalism across the board. We have already seen many legislative changes that are consistent with a kind of increasingly nationalistic perspective. Here in the US, there's new legislation, for example, that is being considered to further expand CFIUS, the Committee on Foreign Investment in the United States, which has already been expanded legislatively over the past couple of years. And so I think that's going to continue to be a feature of the global environment that will only grow stronger as the tension between the US and China builds. And then I think the final part involves pressure on supply chains, and there's a short-term question involving, and this actually feeds into the inflation question, because obviously the transatlantic cost of shipping goods from Asia to the United States has tripled over the past several months, or past several quarters. There are constraints on, offloading at Long Beach and Los Angeles, and so on and so forth, that probably are not going to resolve themselves until late summer, early fall, in terms of that backlog. And then there's the broader question of whether supply chains get shortened and renationalized. I think on that question, there's been a lot of hype, and it is very difficult to actually move full supply chains dramatically. So I think there's been probably some overstatement of that, but clearly there are many, many complicated factors that are on the minds of lots of corporate executives with regard to US and China. So that's the first part. Second point is broadly on the response. I mean, clearly the fiscal policy response this time has been dramatically more forceful than it was the last time around. I think that is obviously to be welcomed. I am glad that we are experimenting with where fiscal constraints may be, where inflationary pressures may actually build up, because I think it is a good thing to kind of test that boundary a bit. We appear to have some scope to do that. The response is clearly different in the United States relative to continental Europe, in particular in terms of the aggressiveness of the response. And I just comment very briefly on where we are right now, because this is very similar to what happened in 2009 and 10, where there was a pivot from deficit finance legislation towards paid for legislation. Then it happened, we went from the stimulus to healthcare. Now we're doing it relief package to infrastructure. It is very interesting to see the similarities there. I suspect on that point that we are going to wind up with more deficit finance legislation, because the process of offsetting things is very, very hard. But the parallels are eerie in terms of the pivot from deficit finance legislation to paid for legislation happening at about the same time in this administration as occurred in 2009.
Thanks, and thanks for that historical note. Gita, there's Peter raised the issue of how big the fiscal response has been in advanced economies. Of course, it's been much smaller in emerging markets and developing countries. And there are quite a number of questions here about, well, is there more scope on fiscal policy for emerging markets, developing countries to expand? And it'd be interesting to get your view on that. And have they been wise, the emerging markets and low-income countries that have used less fiscal space, or was it just exigency? They couldn't get the money to expand more, and trying to expand more would be difficult. So over to you, Gita.
Yeah, hi Caroline. Before I respond to that, just very quickly on the point of scarring and even for advanced economies. So firstly, there's a very diverse picture even among advanced economies. One of the issues we have flagged, we actually have work on, is on insolvencies rising as some of these extraordinary measures are removed, like when you remove the moratoria on loan payments. So we actually are working on that. I saw a question in chat that asked about, is there numbers on it? And yes, we do. Again, the data is for Europe and a few other advanced economies, not for the US, but I don't think it's such as big a problem in the US as it is in those other parts of the world. So that's indeed the case. But I think what I want to highlight was that even and by the way, this is not a risk situation. This rise in insolvencies is in the baseline for a bunch of countries, because it will go up just given how low it's been now. But I wanted to highlight that even in the baseline scenario, the divergence between where we're expecting advanced economies to go and where we're expecting emerging developing economies to go. And of course, there's tremendous uncertainty around it, but I think it's a stark difference even in the baseline. To your question, Caroline, about the difference in space. Yeah, I mean, in spending, advanced economies have, if I remember the numbers, budgetary support was 16% of GDP so far. Emerging markets 4%, and low-income countries 2%. I mean, even for advanced economies, this is like 4 to 5 times of what they ever did after the GFC. So, even for their standards, this is very, very high levels of support. With few exceptions, most of the emerging and developing economies haven't done more because they have much lesser space. They cannot let their debt levels go up as fast. The borrowing costs respond much more strongly when they try to do that. And so it's just, there are, some countries which made a conscious decision that they didn't want to spend more, but I would say the vast majority were where they did what they could, and that's as good as it got. So how do you deal with this? Now, I think the strategy has been firstly to, which will continue to be the case, is to reprioritize spending to make sure that you focus on the need of the hour, which was health, income transfers to the poor. So those were areas that you want to focus on, to kind of very targeted support, efficiently provided. I mean, that's one way to deal with it. But I would say that over time, now is not obviously the time, but over time, the countries will also have to deal with an issue that they have tried to address for a while now, which is increasing tax capacity. There are implementation challenges. The base is small. In many cases, it's not progressive enough. And so all of this is where more action will be needed. It's unfinished business from before this crisis, and it will be required over time. But in the meantime, of course, it's absolutely essential that these countries receive financing, at somewhat favorable terms. And because interest rates have been low, even taking into account this recent run-up, for many countries, they're still able to tap markets at low rates. Secondly, of course, institutions like the IMF have provided concessional financing, emergency financing to a large number of countries, like 86 countries, so that they could tide over these very difficult times and not have to rely on raising more revenues at home. And then, the problem is not going to be solved for a bunch of other countries. Again, in terms of, debt relief has provided some more space. Debt restructuring, something that Peter mentioned, will be needed for a bunch of countries. So all of these measures have to be there. But again, if I were to just step back, I would say that the problem gets worse the longer this pandemic lasts. And it's true, for everybody in the world. It's particularly true for emerging and developing economies. So the fact that there is this big gap in access to vaccinations that Peter mentioned is a big problem. And while there is a lot of supply that's in the pipeline is coming through, I think there is a distribution issue of how do we actually reallocate surplus vaccines from the rich world to the poor world that don't have enough of it. So I would start by saying that the absolute number one priority, even for emerging and developing economies, from their own financing perspective, from the international community's perspective, is to get to widespread vaccinations.
Thanks. And it is very useful to have the reminder that the reason we had this recession was because of a public health crisis, and that public health crisis is not over. And I think that to the points that both of you have made, we keep thinking it's over, or we keep expecting, way back in November, that markets decided, okay, we've got a vaccine, we don't need to worry anymore. And we're discovering the difficulties of getting the vaccine out and persuading people of its safety and so on, and getting it to the right places, as you mentioned, Gita, all the time. Although one thing that strikes me is that and Peter, you kind of mentioned this, but the projections for growth and actually the growth performance has not really been closely linked to what happened with the pandemic. We see that, well, the UK has got very low growth because it had a very big recession for many reasons, not just the high level of deaths, but we see in the United States, perhaps it's clearest, that the death rate has been so high and yet its economy is looking stronger. So is that just the push and pull between macro policy and health policy? Or is it that if you don't lock down, a lot of people die and some services don't work so well? But I'm going to come first to you, Peter, but other things carry on.
Yeah, I think it's a combination of factors. The first and most important is just the massive fiscal response. The fact that credit card debt fell, credit scores improved, household savings went up in the middle of a pandemic highlights how aggressive the response has been. That's the first point. The second point is there is a lot of activity that can migrate. The fact that we're doing this in this format matters. So it's not to say that the public health or the virus itself has no economic damage. It does, but at least partly offset by strong policy response, partly offset by shifting of at least some sectors and some activity to virtual, more meals ordered by delivery, less in the restaurants, less shopping at malls, more ordering from mail order and other online places, which, by the way, have exacerbated many of those logistical issues that we talked about before, because the way in which you populate or get goods to malls or big stores is different than the way that Amazon stocks itself. The way you get food to grocery stores is different than the way you get food to restaurants, and so on and so forth. I think the other question, though, is there's at least some suggestive evidence, which is what I said, and I don't want to overstate it. Gita may have a comment on this also, that in the last couple quarters, people may have gotten a bit better at figuring out how to function in the new environment. And so the economic impact, controlling for government relief and controlling for the kind of shifting, that it may be somewhat, the economic harm may be somewhat attenuated. Let's put it that way.
Thanks. And to you, Gita, and I'd like to allow you to pick up more on this issue of spillovers, if you would like to. In particular, if we assume that US interest rates will rise with recovery, is that going to have more of an impact on other advanced economies or on emerging markets and low-income countries? How do you see that playing out? We know that the United States its actions influence the rest of the world a lot. When there's a big QE, one of your predecessors, Raghu Rajan, complained about how that was upsetting monetary stability and financial stability in emerging markets because of so much liquidity. Then the taper tantrum led to a lot of complaints in the other direction, that the US was too tight. So how do you see, and you talked a bit about it matters if it's good or bad interest rates going up, but where do you see the impact falling most?
Caroline, again, just to respond first to what Peter asked about, is this phenomenon of people adapting to living in these pandemic times, is it a global phenomenon? It is absolutely. I mean, we look at the 190 member countries data, and it's not just a few countries, or it's not just the rich world where you're seeing greater adaptability. You are seeing that across the board. It surprises on the upside. Let me just tell you that when we put out our projection in April 2020, which was locked in March 2020, the beginning of this pandemic, when we literally, we were flying blind almost. We had projected that 2020, the global economy would shrink by 3%, so negative 3%. Right now, based on our projections, 2020, our estimate is that the global economy shrank by 3.3%. And by the way, if you actually, the PPP weights change. So if you actually put the PPP weights on a comparable basis, it's kind of freakishly the same. So it's minus 3.3, minus 10. I describe that as a happy coincidence because the details changed around quite a bit as the year progressed. So, what do you think, where were the surprises? I think the surprises on the positive side. So in our original projection, we had advanced economies being hit worse than they are, especially the US. And so kind of what changed? I think the parts where the surprises came up on the positive side was the countries that put in even more fiscal stimulus than we could have projected at that time. The countries which are, the fact that we got multiple successful vaccines, which, given a year ago, nobody would have thought was possible. So the countries where that vaccination is happening at a faster pace, those are precisely the countries where you're seeing this kind of, a faster recovery. And so again, for the rest of the world, if you want to make the recovery faster, those would be the dimensions on which action would need to be taken. In terms of these spillovers, Carolyn, that you talked about, this is, I went into a lengthy discussion about this right at the beginning. And again, the question you often get is that, are we kind of in a 2013 taper tantrum kind of situation where we have to worry about some sort of also, do we have to worry about a systemic emerging market debt crisis? Again, there are a couple of reasons why there is cause for concern, which is one, that many of these countries are still, only weakly recovering, high levels of debt, need external financing. But on the positive side, many of these countries have much higher levels of reserves, and you didn't have a big borrowing binge on the external account in terms of current account deficits as what preceded 2013. And also, I just want to pause and just remind remind everybody that if we were having this discussion in October or in July, pre-vaccines, pre the situation we are in now, I think we would be even more worried about the scenario going forward if this was going to be an even more prolongated pandemic. So I think there are individual countries that are more vulnerable among emerging and developing economies in terms of, kind of the typical large external account crisis or something of that kind. But there are many others that are in a better place, and especially those who benefit from trade with the US, who have benefited from higher commodity prices. Now, what I do worry about, of course, is that even if there is no, big bang kind of a financial crisis you see externally, many of these, I shouldn't say many, but there are countries in this group that may be okay in terms of their reserves and externally, but still have pretty vulnerable domestic financial sectors. So you might have a situation where the recoveries become even slower because they have a large amount of non-performing loans, and that restricts credit growth. And so again, while you won't see a loud kind of a crisis, but you might have this, very weak recoveries, and that's important. That is something to worry about. In terms of what the Fed needs to do, what countries need to do. I said that right at the beginning, so I'm not going to repeat myself.
Thanks for that. Peter, I want to ask you about how you see these flows. Emerging markets obviously have, along with all borrowers really, have seen big inflows. Is this something to celebrate, or is this something that will be a harbinger of problems to come? And maybe you can also, you were critical, and I think we need to have another session on the whole issue of sovereign debt management, but quite a few people in the questions have also raised a question of China's lending, which appears to be on quite fierce terms, not in terms of interest rates, but in terms of the ability to restructure, and how much of an issue do you see that being going forward? So over to you, Peter. And then just to let you know, we have a little bit more than 5 minutes left. I want to come to both of you on the issue of inequality, which has been raised by a number of people as something, and you can take it. Somebody in the questions has said, has COVID caused more inequality, or inequality that's already there to get worse? And of course, we know that between countries, inequality had in the past been improving. But anyway, I'll just to give that thought to you, and go first to you, Peter, on the emerging market flows.
Sure. So I think you have to go one layer beneath just the flows themselves. One of the encouraging aspects of the flows that have been occurring is that they are more than normally involving equity as opposed to debt. And so you have to, there's no blanket statement that we can make about flows good, bad. It depends type, country, denomination, et cetera. So I'll demur from making a blanket statement, other than to say, I think fairly clearly, if the flows can take the form of equity rather than debt, that's desirable. And there's some evidence that at least recent history suggests, there's been a bunch of that. Secondly, on China and debt, I would go broader than that. I think that the participation in the common framework has been lackluster so far. That a key piece of this involves lining up the commercial creditors to voluntarily participate alongside official creditors to make sure that what you're doing along one domain is not harmful along another. A lot of countries are reluctant to do things with official creditors that then may harm the private contracts that govern, or not harm, but trigger various things under private contracts. And so I think in addition to the sovereign debt restructuring process that we had touched upon very briefly, there is a big question about how to get commercial private sector lenders into this activity more forcefully, which often is in their own self-interest, because you can, by buying time, produce a better outcome overall. Really briefly on inequality, I'll just comment on the US for a second. It is clear that we have had significant rise in inequality. The impact, the shock itself from the pandemic makes that worse, because many of the evidence suggests many of the jobs that disappeared were in high income areas, but for low income workers. And the only thing I'd say is we are in the midst of a massive shift in the progressivity of government policy in particular, as embodied in the $1.9 trillion package that was already enacted. So there's one thing that involves the sort of the market or pre-intervention dynamic, and then layered on top of that is a potentially a historic shift in the size of the response, especially on things like child poverty and what have you in the US. And then obviously there's a global dimension, but I want to leave Gita a few minutes at least to wrap up.
Thanks so much. So over to you, Gita.
Yeah, so I mean, the rise in inequality within and across countries is really a major issue. Now, in many countries like the US, in Europe, more generally advanced economies, I would say that you did see that income inequality rose because certain kinds of jobs were hit much hard. Lower skilled workers were hit much hard. Younger workers, women in some sectors were hit much harder. But if you look at what, the fact that a lot of their lost income for a lot of people was replaced, consumption held up across these different groups. Now, that, of course, was not the case in many other developing countries where you just don't have the resources to make those kinds of transfers. And so, like 2020 was a year that we estimate 95 million more entered extreme poverty. And so, the problem is just a whole lot more severe there. And then in terms of the cross-country picture, in the decade and two before this crisis hit, we had convergence in income levels towards advanced economy standards from emerging and developing economies. But when you look at the data now based on our projections over the next few years, we have that about half of those countries that were converging are now expected to diverge. So again, these are shorter windows. We're looking at the next 3 to 4 years. Over time, as potential is much higher in emerging and developing economies, the convergence should hopefully restart again. But again, it's taken a big knock, and which is why some of the ambition that was displayed at the country level in terms of support to their own people really needs to show up at the international level too, in terms of just having much more stronger global recoveries.
Look, thank you both so much. It was really a terrific event. And of course, there are absolutely tons of questions that aren't answered, but we'll give food for thought. And I want to thank Peter Orszag, CEO of Financial Advisory at Lazard, and Gita Gopinath, Chief Economist at the IMF, very much indeed, and to all of you who listened and asked questions. Thank you.
Thanks, Caroline.